Thanks for joining us again for our fortnightly HLB community broadcast. Our panelists this week are Todd Gammel, and Nicholas Guest and Peter Bembrick. So the three panelists will be talking about, in Todd's case, he'll be talking about the new operating environment, the fact that we're in recession now, technical recession. There's a lot of impacts around that we don't know about at this point in time. How do we plan and adapt for that? And the need to focus on financial management and stakeholder communication across multiple stakeholders. So Todd will have a look at that. Nick will talk about key considerations from an audit and financial reporting perspective, looking at things like fair values, going concern disclosures, intangibles, and other things like that. And then finally, Peter will, not a lot to talk about on JobKeeper, but Peter will have a look at end of year tax planning tips. So Todd, I'll hand over to you to get us going.
Thanks, Tony. Good afternoon, everybody. I'm going to talk about some really fun stuff about economics and how that's leading us to a recession. But in there is some things to think about and how we adapt to it and what impact it has going forward on all the businesses and clients and things like that. So it's a necessary sort of approach. So flip over to the first page. So here's probably the most concerning thing going at the moment is unemployment, and expected to hit 10% at the end of June. The issue I think that sits in underneath this and as part of this is where is the underemployment that's in here, because we have a number of people who are actually working 4 days a week and less rather than their 5 days, and there's obviously a lot of casual workers who may not fall under the employment or unemployment sort of scenario. So there is a larger workforce outside of this 10% rate. That has to hit the economy when you have 10% of the people not being gainfully employed. And obviously it's likely that will change again, probably unlikely to decrease when JobKeeper finishes in September. So there are some people who will be released into this unemployment number once JobKeeper finishes September, October. So that's good news. Let's get into the next one. So this is the consumer sentiment. So April, we bottomed out. So it really bottomed out in April when everybody was stuck at home and everybody was spending all their time talking to each other and trying to figure out what was going on. So the concern really factored into that. There are some shoots of green coming through in May, and it'll be interesting to see what happens in June, whether that flattens out or whether it comes back up, because I think there will be a lot of variance across the economy about how that's going to play out. And as you can see historically, this landscape or this index has given a real indication of where people are thinking and the investment sort of structure, and it maps pretty closely to the way that the RBA has looked at the economy and have been trying to manage it over that 10-year period. So there is some upside, but it's about how that levels out in the next few months. Next slide, which is the business conditions. So this is another one which has gone the other way. So the business assessment is further negative. So consumers were positive, a bit more positive in May compared to April, but businesses crashed and burned down 36. So it hasn't been this low before in the last 15 years, and that's indicative of the issues that we're facing and I think the inherent uncertainty that everybody's looking at on a business basis. Hopefully, as things start to emerge from hibernate, some confidence returns, or at least some comfort that they're not going to get any worse, and that will bring that back up. Because if that's the business conditions assessment and that stays at that level for a while, we're in for a very extended recession, because everybody will be very conservative about deployment of assets and cash and all of those sort of things. So that's the economic stuff. Then we get into the impact unknown about now we're awakening from hibernation and we're in a recession. Some areas of the economy are going to have pretty strong outcomes. There are obviously the government's concerned around the construction and the building industry, having released that specific impact or that specific funding model yesterday. It's yet to be seen how that will actually have any impact. There's a lot of conditionality around it, and it's hard to see how people earning the money that they have limited it to around that 125 individual to 200,000 for a couple will be able to borrow enough to be able to make the system work. But we'll have to wait and see how that goes. Some businesses the ones that were struggling may prosper, so they may come back because their bit of the niche market actually comes stronger. I think if you were running a glass and a plastics business before, there is some opportunity there to be able to get into the safety market and work safe sort of issues, and being able to provide sneeze guards and things like that. So those things will be able, if you can pivot, you may well be able to make the most of that. And then there will be these other businesses which just roll along and hopefully just stay afloat just so because they can. There's going to be available workforce. We've just gone through that. There is going to be unemployment. The difficulty may be we might have pockets which are just not the right skills. I think we can see that there's probably not going to be the return to all of the jobs in hospitality and retail. So there may well be a surplus of skills in that area, but there might not be skills in the new areas that emerge out of this. So there's going to be opportunity for businesses that can train in those areas as well and bring staff through to build through. We're already starting to see some new relationships and approaches and funding structures coming through, because people are now just looking at every option they can to try and protect themselves, their wealth and their businesses. And that will be across new security structures, willing to look at joint ventures and partnerships and seeing how that all flows through to create value. And there still is this government program opportunity around, I suspect training will be one of the big issues they will fund, and there will be investment from government, probably in infrastructure and also these other programs. The big blue sky is being able to adapt to the new landscape and find value that other people can't deliver. And that's where somebody may create that competitive advantage, at least for a short time, before everybody else catches up, or they may create a longer term structure if they can build the delivery of the right service or the right product at the right time. The next slide. So how do you actually turn that into a financial sort of response? Our view is that you need to be looking at your cash flow on a weekly basis at the moment, making sure that you're being conservative and you understand how it all fits. Even if you are relatively stable and profitable, having an understanding of that will give you the opportunity to be able to look at for new investment, buying competitors, buying somebody else in your supply chain, and looking at stock acquisitions at discount and all of those sort of things that can bring you margin in the future. I think that you need to do your 13 weeks, then you need to get out to 30 September and understand what you think is going to happen then when the changeover from JobKeeper occurs. And you may need to adjust that on a month-to-month basis because things will move around, and then beyond to 31 December 2020 when we may have a new normal and what that looks like and how that plays through. The other things are to think differently, contemplate all of the things that you can do, and don't be restricted with having to do the same things the same way you've done it, and maximise whatever you can get out of government funding. The carry packer rule still applies. Don't give them anything more than you need to, and take anything you can get. You've got to also massage your bank, I think, going forward, particularly if you're asking for deferrals and whatever else, and have some options there that you can work through, and a mature discussion with them about how they're going to get to, because they are, from talking to a number of the guys that we deal with inside the banks, they are going through their books and they are looking at the ones that they are concerned about and trying to help them through if they will let them. So it's just about working through that. The big thing is, out of that, you need to have the information to be able to understand the options and make decisions. So if at present your reporting framework isn't good enough, you need to enhance that. and you need to be able to make sure that that is strong enough for you to be able to rely upon, timely enough to be able to give you the information at the right time, and then reliable enough so that you can make those decisions, or your clients can make those decisions with strength, and be able to know that they're doing it on the basis of the best information available. And the big conversation at this time of the year, particularly when family trusts are being reviewed and distributions and things like that, is how the family jewels compare to the business and what's more important, and being able to secure funds being lent to businesses and in investments, so that you protect those funds going in now, particularly in a period of uncertainty as we have. If you're willing to take the punt, that you should try and protect your position as much as possible, and try to separate emotion from decision making as much as possible. Make it on the numbers rather than the issues around it. And all of those things can be rolled into one plan. And a lot of businesses are going to have to provide that to the bank. They're probably going to have to provide that to the ATO, their landlord, and some other partners, depending upon whether they are, if they're profitable and streaking ahead, they're probably going to be less necessity, but the bank still may ask for it. If they're going to need payment arrangements with the ATO and their landlord and the bank and all of those things, they're going to need to have that document put together so that they can massage that. And rather than doing 4 or 5 different documents, we always suggest do one. You understand what it is and you can always talk to it. It makes things a lot easier. And that's pretty much where we are at the moment. And of course, just as I get to that point, Tony goes missing. It's always the way. So that's pretty much where we're seeing this week. There's obviously a big issue with a recession coming. What impact it has, we don't know, because we haven't had one for so far or for so long. And there is so much money still lying around in the secondary market that people will be able to obtain funding. It just may be very expensive. The big question is whether it is the right thing to do, or whether it is now a time to make a determination that let's cash in the chips and see whether we can go somewhere else. All right, so that's it from me. Happy to answer any questions at the back end, and I'll hand over back to Tony so he can get to Nick.
Yeah, thanks, Todd. Please do fire through questions as we run through, and Todd, Nick, and Peter will answer them as we go through, and catch up at the end if there's any left over. So I'd just hand over to Nicholas Guest now, who is our Partner Audit and Assurance and Corporate Advisory. Nick, over to you.
Thanks, Tony. Good afternoon, everybody. This afternoon, I'm looking to cover off on some of the considerations for our clients and entities who are required to prepare financial statements, generally under a general purpose framework, and or for submission to a regulator of some sort, or a finance provider. Everybody's starting to turn their mind to some of the impacts of the COVID and then the current environment, and how they will translate through to our financial reporting. ASIC and some of the other regulators have come out with some pretty strong guidance to directors and entities on their expectations in relation to disclosures that will be included within those financial statements, making it very clear that they anticipate full disclosure of any potential or likely impacts on those financial statements. And when we turn to thinking about financial reporting considerations, we typically think about areas within those financial statements that are subject to degrees of judgment and potentially some uncertainty around estimates. So financial reporting impacts, we're seeing everything from the consideration of the recoverability of loans and receivables, trade debtors, thinking through around previous assumptions around credit loss on those trade debtors. They may not be valid in the current environment if our clients and customers are suffering some significant decline and impacts. Obviously, fair value assessments in relation to any assets, such as investments in other entities. Fair values of property is an area of considerable concern for some clients of ours. If they've got exposure to retail properties or other properties where the tenants have sought some sort of rental relief, how does that impact to the longer term view of the value of those properties? So the key takeaway for us is that there needs to be early engagement with our clients, discussing with them how they're going to establish values for some assets, which in the past may have been quite straightforward. Considering whether there's any liabilities which we should be starting to bring on into the accounts that we may not previously needed to recognise, potentially for onerous contracts or similar. And if we're going to need greater information to support our carrying values, if we need to provide that through to auditors or the like, make sure that we're speaking with experts early. So whether that be property valuers, if we need to revisit some asset values or similar. ASIC's been very clear in terms of disclosures around impairment considerations that they want, and they expect that there'll be a more rigorous process than has been historically. Impairment of intangible assets is an area that is of consistent focus of ASIC. I think in the current climate that will only increase. And the going concern assumption for the entity in its own right is a very valid concern for some entities. What is their ability to continue as a going concern, and what measures have the directors stepped through to land on that? And there's obviously the commercial considerations, but under both the Corporations Act and the accounting standards, there's some pretty clear guidance as to the processes that directors and key stakeholders should be working through to consider their going concern obligations. For some entities, this may just flow through to additional disclosures within the financial statements. We are seeing in many financial statements specific COVID-19 related disclosures where they're articulating the actual impacts they're experiencing currently, but also their view of future impacts because of the COVID-19 and the subsequent impact on the economy and the market. So that is something again which needs to be considered. Point here in relation to if these entities are subject to external audit, I would encourage early engagement with the external auditors in relation to them, the auditor being able to gain comfort over those financial statements and any areas of increased subjectivity or judgment. There may be the need for an emphasis of matter to be included within the audit report, referring users to specific disclosures within the financial statements. So again, it's something that directors should be aware of. An area that we're very live to is the potential for clients to be in breach of covenant requirements within their financing agreements. There is a requirement under the financial reporting standards that if a covenant if a borrower is in breach of a covenant, it's likely that debt facility is going to be recorded as a current liability as opposed to a non-current liability. This is going to see a restatement within those financial statements and potentially a flow-on impact to the going concern assumptions and the like. So it's something to get on top of early. Have clients perform their covenant testing and be prepared for additional amendments to the financial statements and related disclosures. The key point here, like on a lot of these matters, is the communication is vital. Get the stakeholders communicating early if they perceive some potential issues in relation to the financial reporting. Engage with those that are going to be using the financial statements. Engage with the auditors. Engage with the the finance providers and so forth, and start the discussions, because we do anticipate that it will take a longer period of time for the necessary information to be gathered, and for audits and the preparation of financial statements. There has been some extensions provided by ASIC for the lodgement of the annual financial statements for the June period. This pushes out for a month, so that is helpful. It may not be enough for everybody, so it does need to be factored in. You may also experience that from the auditor's perspective, they may incur or require additional time in order to be able to gain comfort over areas of increased subjectivity. So start the communication early, and put a plan in place to work through those areas which are going to be of the greatest subjectivity and potential change from prior periods.
And Nick, that process is also going to drive a few other things as well, isn't it? Like documenting the landlord arrangements and documenting your waiver of your covenants with your bank if need be, and all of those sort of things are going to come through, even though that may well be in place, but just hasn't been documented because the audit's going to require to see it.
Yeah, and look, that's some essential considerations, Todd. If that entity is likely to experience some pressure on their future cash flows and need, in order to be able to satisfy themselves that they're going concern, be reliant on changes to their financing arrangements or changing to their lease payments. And look, to be honest, some entities are going to be reliant on, in the near term, on the government stimulus payments, which obviously have an end date. So being able to have those detailed forecasts, which I know has been a subject of a lot of discussion, it becomes more and more critical. But then having that documentation in place to support that is, yes, absolutely critical. So look, that's I guess a brief snapshot of what should be considered for financial reporting. I guess the key takeaway is everything needs to be looked at in quite considerable detail. Disclosures and balances, which in the past have been quite simple and straightforward to prepare, may now be subject to much greater audit attention and obviously financial reporting attention and related disclosures.
And the big thing there, Nick, is that the change potentially from categorising the assets on a going concern back to a liquidation or a realisable value and that'll blow covenants as well. And that's what everybody's got to think about. And then there's obviously potential for people who are just over the threshold for audit and have been for a while, slipping back below as turnover drops the last 3 months.
Yeah, it's all very relevant considerations. I mean, we often caution entities that may be dipping below an audit threshold to have a view through to what FY21 may look like. So there can be reasons to maintain a continued audit history, not just for the not just for the benefit of meeting the ASIC reporting requirements.
Thanks so much, Nick. I'm happy of doing that. Thanks very much. That was great, and thanks, Todd, for your input as well. Now, last but not least is our favourite tax consultant, Peter Bembrick, who's going to give us a few end-of-year tax tips to think about. Over to you, Peter.
Okay, thanks, Tony. Thanks. Welcome, you guys. We've at least got 6 of you. Anyway, I think you're about half the number who registered. But so this is, I'm not sure if any of you were here last time, but these slides are almost identical to what we did last time. So I'm going to try not to be too repetitive. JobKeeper was our first slide. We've spoken so much about JobKeeper. So just a couple slight tweaks that have been changed. I think I might have touched on in the last webinar that we've now got till 2 weeks after month end to produce the monthly report. So that's sort of a permanent basis. The other thing is that I think think 30th of, so that's sort of permanently. And also one thing the HO has said is that you've got now until the end of the month to as long as they're being paid the equivalent of, so the employers have to be paid the equivalent of 1,500 a fortnight, but they can certainly register up until the end of the month if you want to make payments. So I think one of the key points we're going to have now, and I know we're seeing with our clients, is that some people missed out initially, but I've got a couple of clients that are going to come in for June. So you'll be looking at the end of June to be able to register them, and then obviously start claiming the JobKeeper reimbursements. So the kit will keep going a little bit longer. It's all pretty, the rest of it, but yeah, not really much else to talk about there. As job enforcement, we're really moving in. So of course we're all live. It's compliance basis now. Enforcement is going to be the thing. So the ATO has made it very clear that they've been through that period of providing guidance, helping everybody get registered, and no, they obviously couldn't. It was enough to get everyone registered. They obviously couldn't scrutinise a lot of that too closely, but they will go back and review. And if there are anomalies coming out, or if things come to their attention, and the ATO believes that people shouldn't have been registered, they will go back and cancel that. So potentially JobKeeper amounts will have to be repaid, and there are penalties associated. So both you and your clients will certainly need to have good records to how you establish the turnover thresholds, thresholds, the decline in turnover, all that's just the eligible employees, having all of the signed declarations in place, all that stuff.
And Pete, I've seen that practically where I've been working with landlords who are making sure their clients or their tenants are eligible under the landlord code.
Yep.
And they come back and they say, well, this entity is our operating entity and it's subject to JobKeeper, but it's not necessarily the tenant. So then they go back and register the tenant, but the tenant might not necessarily have any employees. So there's all of those sort of things that people haven't thought about in terms of their structure, which are bubbling through now.
Absolutely, yeah. So that's right. So there's a lot of the detail there that, and the HL will go over that detail, and hopefully they still, in some cases, they may still be relatively lenient. I mean, the practice, certainly the guidance that we came out was to identify when they talked about schemes, the schemes they'll look at and the things that they believe are okay. So, you want to be aware of all of that guidance so that you know where the risks are, and so that what the sort of things the HL is going to look at, and then have the records to back that up, which, as Todd says, has flow-on effects, but beyond just claiming the JobKeeper things, reimbursements themselves. So we can go to the next slide probably. This slide is what we went through in the last in the last seminar 2 weeks ago. So for anyone who was here, but certainly I think most of you weren't. So just starting to think beyond JobKeeper now. We're coming even closer to year end. So it's mostly the same sort of stuff as that you would do every year, but I guess particularly important this year to think about what you need to do leading up to year end and beyond. So Division 7A, that one of those perennial issues. So one thing the ATO made very clear, which taking us right up to today, because a lot of the company returns had extensions, lodgement extensions as a blanket rule, which normally they'd be due 15 May. So you would have to, 15 May would be the deadline to clear out Div 7A loans or take the action. The ATO made it clear that the 5th of June was the date. So I wouldn't say that applies. I know we've applied for a number of specific extensions for certain clients, and I don't know that I'd rely on that for those people. But certainly for the blanket extension, the ATO is clear that you had to. So I would suggest that 5th of June would be the date you'd be looking at. So if you're looking to repay Div 7A loans or put them on loan agreements, those sorts of things, then if it hasn't already been dealt with, should be dealt with by today. And that could include things like putting journals through to declare dividends, but whatever needs to happen, just make sure it's sorted. But that raises the question, if you are going to use that strategy, which is obviously a very common one of using dividends to clear out loan Div 7A issues, are there enough, given the current conditions, are there even enough profits? Are there the franking credits there? If you've been varying in tax instalments, or if tax liabilities are going to be down because profits are down, are the profits and franking credits going to be there to pay the dividends, or are you going to be in a position where companies have unfranked dividends required, and hopefully you don't get in too many of those vicious cycles with divisions of 7A where you've got dividends or something that has to be done to repay the loan, and if you're repaying Div 7A loans with unfranked dividends, that's certainly not very tax effective for the individual shareholders. So just working through all of those things, which again, there you're dealing with probably what's already happened, but certainly in the 2020 year and beyond, if people are borrowing from their private companies, then what is there's short-term fixes there, but what happens then, and really goes to some of the things that Todd would have been talking about as to what's the outlook. If people are having to strip cash out of their companies, if the cash is there, there probably are bigger underlying problems in the business and in the overall structure. So just being really careful and being aware of what your clients are doing, and planning for that, and seeing, we know Div 7A is often not a great. If you have to rely on Div 7A, that's often not a great outcome. So are there other things that should be being put in place? So
yeah, because Peter, with less cash being around at this time of year, people are less able to sort of repay things and whatever.
Correct.
Else.
Yeah.
Because they've used it for working capital and run down, or had to pay for things to keep.
That's right. Going. And if it's a bit, and of course, if you and the worst, where I mentioned about that vicious cycle, the worst scenarios are where you have your last year's loans and you're repaying last year's loans, and then you end up having another loan, and you get a whole succession of Division 7A loans, which potentially the problem can build and build and build, and it's very it can get very ugly. So taking that, stepping back.
That's what you tax guys get paid for, though, isn't it, Pete?
We do our best. So maybe we do a restructure or something, but but again, you just got to start looking at and doing some planning. So yes, there's obviously things we can do, but of course we may not be able to. You may not be able to solve it all from a tax perspective. So that's why you got to look at look at it from a commercial and a business perspective as well, and make sure that what makes sense for tax also makes sense commercially, and. So, but yeah, definitely could raise all sorts of issues. Just talking about investment structures, the next point where we've got investments through companies and trusts, entities. Okay, investment advisors might say, well, don't lock in if you can avoid it, maybe don't realise the losses, don't sell at the bottom of the market, but unless you have to. But if there are real capital losses that are being realised or have been realised, or you're just very forced to realise them, thinking about how you can best use those losses. How are they going to be available in the future? And not getting losses trapped in a particular entity where you potentially got profits or future gains and profits arising in other entities. So these are sort of planning, again, you should always be doing, but particularly important leading up to 30 June is that you think those things through and getting into the next year. Income splitting and negative gearing. Well, I mean, if incomes are down anyway, just thinking about what you should be doing there, what you should be doing at 30 June as you're planning for year end. What should they be doing next year? Again, perhaps obviously interest rates are lower. With being so low, negative gearing probably has less impact than it used to. But income splitting, if people are maybe two income households have gone down to one income households. So, you've got the situation certainly change. And so if there's income to split, how should that be done? Just again, it raises more planning opportunities. And then when you move on to property, then, touched on before about all the rent relief. If you're a landlord, even if it's just a small scale, commercial or residential investor, if you're having to give rent relief, then what is that? Or properties are vacant. where does that leave you as an investor? And you sort of heard, there's, again, I mentioned this last 2 weeks ago when we spoke, there was a story in the news about some lady that it wasn't only owned one property, but was renting it out. So was she and her children were renting, single mother, and the news headline was something along the lines of that being, she had given one of her tenants rent relief because they lost their job. So then her income was down, and yet when she went and asked her landlord for relief, they just didn't want to talk about it. So you know, there's possibly lots of stories around like that and things that, so it's just, if your clients have got these sort of issues and got investment properties, or if you're advising more sophisticated, substantial investment entities and structures, there's a lot to consider, you know, whether they've got commercial buildings, shopping centres, whatever they've sort of got. There's obviously a lot of things to issues that need to be looked at this time. Okay, so just finishing off with the personal point of view, look more, again, personal tax planning this year is probably going to be the usual things. Home office expenses is just one point that's come up more recently. Obviously, a lot of people are working from home, so the ATO has this 80 cents per hour rate, which is more than the regular rate, because it applies a bit differently. So there's a couple of different ways you can claim home office expenses. So just with more of your clients actually working from home, if you're doing returns for individual clients, then looking at how they can be, what can they claim, and what sort of record. Most likely they're keeping, and the special rates only apply for that 3-month period, for the period up to June, from that sort of 3-month period from March, and so, you know, there'll be a bit of a different approach than previously. The potential claims might have been so small you might not have even bothered looking at it, but this is certainly something you'd look at this year. Otherwise, it's the usual things. If there's a refund, if people are due a refund because their income's down or for similar reasons, you might be looking to lodge some of the 2020 returns early. Then you might otherwise have been a concern for some clients. Thinking about if they're looking at, if the outlook for 2021 is less than 2020, then again you'd be looking at perhaps bringing forward deductions into this year and pushing back income. You might do that anyway from a timing perspective, but it might even be more important this time. But then, you know, what is next year going to look like? And so probably again makes that whole question of year-end planning more important. And if you're anything like us, where you're still doing the tail end of the 2019 returns, having spent a whole few weeks advising on JobKeeper, and then still doing FBT returns, and extensions are all very well, but then people want FBT information for their to finalise their payroll reporting, and then you're doing all of that, but really what you want to be doing is getting out and talking to your clients just before year end about where they're placed and doing a bit of planning with them. So again, it's very difficult thing to do, but obviously perhaps more important this year than ever. So the poll question we put up there was just how have you been able to do that, or have you scheduled in sort of planning meetings in the coming couple of weeks, and do you feel that you've actually been able, given everything else that's going on, especially for your business clients, that you feel you're able to do that? So that was the question that's just been put up on the screen there. Interested in people's experiences on that.
Are people also just not wanting to do it, Peter, because they don't want to spend the money?
Well, there's that as well. Yes, that's right. They don't see the value in it. But that probably applies to a lot of things. People might not be doing things, which is then obviously going to impact your practice. But maybe they're not doing things they should be. So you got to sell them on the idea of that it's important. So, okay. So Tony, that's it for me. I thought I was reasonably brief.
Thank you. I think we're ahead of schedule this week, which is a first. Look, thanks to all the panelists. Please, for those that are listening in, please feel free to reach out to Todd, Nick, or Peter individually on any of the stuff that we covered today or anything else. And I hope you all have a wonderful long weekend. It's sort of easy to forget that it's a long weekend when you're at home all the time, but it is. And also, you will have already hopefully got invitations to a webinar next week that Todd is hosting along with Simon James, at which we're having a private equity firm by Anacacia Capital joining them for a Q&A along with one of their investee company CEOs, I think, which will be incredibly interesting. So hopefully you'll join Todd and Simon for that webinar next Wednesday.
We're gonna on that one we're gonna try and take away a bit of some of the mystery around private equity and how it all works and what they're actually motivated to do, to make it a little bit more realistic and give some practical sort of understanding about how it works, because it does have a bit of mystique, and it does sound a little bit like the barbarians are at the gate sort of scenario again. So we were just trying to bring that back to talking about exactly what it's like and the approach that they bring through. And because I think in the next phase, there's a lot of money in private equity and they're looking for the right type of businesses, and some businesses could really use that support and assistance to take the next step.
And actually, Todd, just on that point, I might just throw in there. So I've got a privately owned client that's quite a successful in a business that's actually been hit in an entertainment sort of industry. So it's been hit really hard in the short term, but is a very strong business, and will definitely pick up. And they've been similar discussions with potential investors for quite a while, and they're in the process of doing a deal with not so much of a private equity firm, and then, well, perhaps it is, but I think they're overseas based, but they're taking a stake in the business. So that's the sort of thing where this particular individual has taken that step, because he really feels that, and he's got a great business, and he's a great operator, well known in the industry. So to take it to his business to the next level, that's what he's doing. He's bringing in outside capital.
And the other factor with that is, Pete, is that also brings that ability for the accountant to transition to being the trusted advisor to help them through that process, and be by their side, helping them manage and sit there and answer those questions, rather than being a bit more of the person who lodges all of the bits and pieces.
Yeah.
There's because that'll build a very strong relationship generally through it, and it's required. The accountant needs to be there holding their hand, because somebody needs to have gone through it with them to understand how it all works.
Yeah, definitely.
Well, look, thanks, guys. Thanks, panelists. Thanks, guests. Hope we can see you next Wednesday. Otherwise, we'll catch up in a fortnight. Have a lovely long weekend, and thanks for joining us today. And keep well. Keep well.